Hello. Good evening, Philippe. Good evening, Tez. Good evening, Rob, Al, Ellie River Blues, Andy, and Johnny. Welcome, everyone. So the screen's working all right?
It is now.
Very good. Okay, so I'll switch to my desktop. So hopefully you should see me in the bottom right corner, and not yet. Okay. Right. So welcome everyone, and I'm going to pop out this live stream, live chat. Pop out. Here we go. And there we are. Good, good. Okay. Switch to my Chrome window. So yeah, the purpose of the conversation tonight is to talk about inflation and deflation, because a lot of people have been interested in that topic, and certainly that video got a lot of traction. So I thought it might be nice to answer some questions about that, or anything in to do with inflation and deflation. So the video itself, I tried to make it so that people could track some of these indicators themselves. So you'll notice that whenever you see one of these graphs, in the bottom right, there's a link. So you can just click on that, or just type in the link. Usually it's with Fred, which is the St. Louis Fed database system. And if you type in that URL, it should pop up that graph magically. And the one that everyone was interested in, the graph that everybody liked, was the one which tracks the probability of inflation and deflation in the United States. So that's this color map. And the link to that is in the video description. Some people had some trouble typing it in. So this is the graph which people found useful. So what this tells you is it's a fairly elaborate model. It looks at hundreds of variables, but it produces a probability of high inflation. So that's the number at the top, which is so 1992. It was very likely, according to this, that we'd have high inflation, and the probability of deflation was 0.2, whereas in 2009 the probability of deflation, because of the demand drop due to the recession, grew significantly. And I suspect what we're going to see this time around as well is that deflation probability may start to increase as we see the reduction in demand for goods and services feeding through into prices. So I think that might be what we expect to see in the next time we get this data. And this updates on a monthly basis, so it is fairly timely. So that's another thing which you may find useful as one of the resources. So let me just have a quick look to see if there are any questions. Oh, there are. Hope you're keeping well and the family is fine too. Yes, they are. Scott says thank you for everything you do. Thank you, Scott. How effective are, so William says, how effective are strategies like buying a property in cash to rent out and investing in stocks and shares to protect your money from high inflation? So this is the idea that you can have physical investments. So this might be something tangible. So for example, it could be It could be something like property, or it could be, I mean, gold is another thing that people consider to be an inflation hedge. Land is another thing people talk about because you can't create more land. So physical alternatives to more financially engineered products. Maybe that's the way to think of it. So property is generally linked to GDP. So if we have very high inflation, then if we get a low growth environment, then that would be bad for property. But inflation itself isn't necessarily good or bad for the property market. But I certainly wouldn't consider the kind of environment we're in now, where growth is going to be pretty weak for a while, to be one where property prices would be particularly an outperforming asset class. If inflation is too high, then that reduces people's disposable income, and that in turn means that property is more difficult to buy. So that's one of the things that may not, if inflation is too high, that's going to hurt the housing market probably. So I don't think housing would necessarily be a good inflation hedge. If you do want an inflation hedge, then probably the best thing is something like an inflation-linked bond. So it wouldn't be property, I don't think. Let me see if there we go. Good. Next question. Hello from Florida. Thank you for doing this. Welcome from Florida. Hi, Amit from India. How do you mitigate against inflation? As I say, I think inflation-linked bonds are probably the best thing to go for. It's one of the few asset classes where you don't want to diversify because you want to hedge against inflation in your own country. So if you have to buy goods and services, what you care about is the price of goods and services which are local. So you don't want to buy US inflation-linked securities, for example, if you're based in the UK. Or you wouldn't buy Japanese inflation-linked bonds if you live in the UK. So don't diversify with it. Make sure it's linked to your consumption, which means it's probably your own country. Okay. Does printing money create inflation? I mean, one of the things we talked about in the video was the velocity of money. So if you imagine for a moment that when the Fed creates money and perhaps lends it out and the asset purchases inject that money into the economy, the question is what happens to it then? How many times does each of those dollars get spent? And that's called the velocity of money. And if the velocity of money is low, then it may be that people just hoard the cash. So if you're a commercial bank, you'd get the money from the Fed and you just put it as part of the cash balance for your bank, and that way it reduces your business risk by hoarding cash. And if you're an individual, you might just hoard the cash in order to survive without an income, for example. So if people aren't spending the money, then printing money may not be as inflationary as it would have been, say, in the 1970s. So let's look at that velocity of money graph I'm talking about, because it's very important for inflation, if I can find it. Velocity. Yeah. So this is the velocity of M1 money, which is the narrowest definition of money, which is just, like coins, notes, which are in circulation. So this is GDP. This is related to GDP. So it's the number of times every dollar gets spent in a certain unit of time. And you can see that the velocity of money was pretty high until we got to the global financial crisis, and then it started to fall very rapidly. So the number of transactions per dollar reduced very, very quickly. And if we do the same for a broader definition of money, which includes money market accounts, for example, the fall in the velocity of money is even more marked since the global financial crisis. So that's why, I mean, if the velocity of money stays low, I think possibly what the Fed's doing isn't going to create a huge amount of inflation. Plus, you've got to balance that with the effect of reduced demand, because if people are spending less, there's less demand for goods and services. That's going to be a disinflationary force. So it's this tug of war between the lack of demand and the Fed printing more money, and I guess a supply shock for some goods and services. Because if there's less supply of goods and services because supply chains are disrupted, that would be inflationary. So there are kind of countervailing forces, and it's just the question of which one is going to win. Okay, and next question. I've learned a lot in this lockdown from your videos. That's Sarath. Thank you very much. How is inflation linked to hedging? So the idea of hedging is a way of reducing risk in your portfolio. So some assets, if you're a professional investor, you only buy them to reduce the risk of your portfolio. It's not just to generate a return, it's to reduce the risk. And that's called a hedge. So if you think inflation's going to go up, so the goods and services that you buy are going to cost more, you want an asset whose value is linked to the rate of inflation. And inflation-linked bonds, by definition, are linked to the rate of inflation. So if the price of goods and services goes up by 10%, so will the value of your bond. So it's very important to understand that the most reliable hedge is an inflation-linked bond. Gold is a particularly bad hedge for small inflation. If you have hyperinflation, gold is a better hedge. But for normal levels of inflation, up to say 5-10%, then you're probably almost certainly better off with inflation-linked bonds. First live session here, great videos. Thank you, Sean. CBE, oh dear. Okay, inflation-linked bonds, yes. I have a question if you find time to answer. What do you think about Peter Schiff's theory about US debt bubble and market crash? I don't know what Peter Schiff's theory is, I'm afraid. Maybe you could, well, if you're a PensionCraft member, we could talk about it on the Slack channel. But I guess we can't on this live session. Comment on possible fiat monetary system paradigm shift. What would be next? Thank you. Right. So, I mean, there's been a big commentary on the channel and on that video by people who think, firstly, that the Federal Reserve is somehow against them, that they're trying to destroy the economy or trying to destroy wealth or just trying to keep bankers in jobs, which I think is complete nonsense. I don't think that's true at all. I do think that central banks are there to help us, to stabilize the money supply and to keep people employed and to ensure that there's liquidity in the system. I think that's very clear if you know any central bankers or if you listen to anything that they say and look at what they do, more importantly. So I think in terms of what could happen if there wasn't money, could we go back to a system of barter? I don't think so. Would we go to a system where it's all done on a decentralized ledger? So, for example, a cryptocurrency? Also, I don't think so. So I don't think we're going to replace fiat currencies anytime soon. The one thing that people want in a crisis is stability. And you're not going to go for something experimental where it's very difficult to spend the money, such as Bitcoin, such as Ripple or whatever. So I think it's actually more likely that we'll keep the system that we have given these kind of crises. It's only when you have the luxury of strong economic growth and no crisis that people can think about things like cryptocurrency. I think when push comes to shove, if you want to go out and buy bread, then it's much more likely that you'll do that with a fiat currency. And just in case people don't know, a fiat currency is a currency which is not linked to any other assets. So it used to be the case that if you had a dollar, you could exchange it for gold. So it was backed by gold, but then that was taken away after the Great Depression, and we came off the gold standard in the 1970s, and there was a huge instability in the dollar for a long time after that. But then we got used to this new fiat system whereby the government says this is worth $1 and we believe it. So it's like a fiat, which means the government is saying this is worth something. And it only works if people believe that piece of paper is worth something. And at the moment, that fiat currency is working very well, I'd say. But fear, I think, is something that would make people stick with fiat currency rather than abandon it. Yep, Bob Taylor says it's amazing to me that word on the street is that we'll have deflation. Well, I think it's the lack of demand which is making people think about deflation. So if you think about what drives prices higher, it's when people want goods, they want to buy services and goods, and they create demand for them. If that demand diminishes, then obviously that's going to push down the prices of goods and services. Of course, it's not true that all goods and services would get cheaper. So certain things are still in high demand. We still need groceries. We still need critical things like gas, electricity, utilities. But what we don't have a huge demand for is things like going out for meals, those kind of services where it's face-to-face contact, haircuts, anything where you have to have some kind of face-to-face interaction. Those are the services which have been hugely impacted. So those are the places where prices would tend to fall, I'd say. So disinflationary initially, maybe, and then once the Fed starts to think about inflation picking up again, they'll be looking for forward indicators of inflation, like the five-year forward rate of inflation, and they'll be looking to ensure that we don't get runaway inflation once things start to improve. But you can bet they'll be keeping a very close eye on that. Is it safe to keep money in the bank now? Or do I need to do immediate investment? Speaking euro or Danish kroner. I think it's perfectly safe to keep money in the bank now. I think, there's no sign that central banks are failing in any way or that we're going to get a breakdown of the monetary system. I think that's just not going to happen. We're still a long way from that. So I wouldn't worry about keeping money in the bank. I mean, if anything, people are now thinking about, what would be good investments in this environment rather than, stuffing money under a mattress, which wouldn't be a good idea in any environment, really. So I would say keep money in the bank. But also start to think about investment, because in this kind of environment, you do get these great opportunities. So don't be scared out of investing for the long term and missing this environment of opportunity, which it always is during a crisis. Don't ruin your returns by being too scared to invest. I read your view on short and long-term debt cycle. How confident are you about long-term cycle predicted in 2020? I think, I don't know if you're talking about Ray Dalio's opinions about the long-term debt cycle. I think he's quite bearish because he thinks a lot of the debt will not be serviceable. So, for example, he thinks treasuries may not be repayable by the US, which would mean effectively a devaluation of the value of US treasuries, or potentially even a US default, which would be utterly catastrophic for the entire global financial system. But I think that's very unlikely. I think the debt to GDP ratio in the US is still manageable. And if the interest rates do start to go up and the debt servicing costs start to increase, the Fed can always effectively, buy those treasuries and push down the yield. So I think it's unlikely that we're going to get, very unlikely that we're going to get a sovereign default by the US. Very unlikely. What I would worry about is a sovereign default of other countries, such as, for example, Italy, where we've seen very weak growth. Their debt to GDP was already high, and the spread on Italian government bonds was starting to increase significantly before the ECB started buying. So that would be very worrying. And also there's a huge amount of Italian debt out there. So that could be a problem. But US defaults, I don't think are an issue. What's your opinion on the dividend cuts to Shell announced today? This is from John Hunt. Well, that's interesting because, in 2008 we saw this too, which is that during a crisis, the revenue of many companies, particularly energy companies, this time round with a very low price of oil, the revenue's fallen dramatically. So in order to survive, to hoard cash, you're not going to pay out your meager profits to your shareholders. You're not going to do buybacks, which were a big prop to the market, particularly in the US over the last decade. So by hoarding cash, you're going to cut your dividends. And so it's hardly surprising that dividend cuts are going to be a big part of this year. So 2020 would be the year of dividend cuts, credit defaults. I think we still haven't seen many credit defaults, and I think that's going to pick up significantly as we go through the year when companies simply run out of cash. If you haven't got large amounts of cash because you've done share buybacks or maybe paid out dividends, then you're expecting things to be fine. You maybe had too much leverage. Many companies are now in that situation. After a decade of very strong growth, people get more willing to take risk, balance sheet risk. And I think those companies are going to have to pay the price. The Fed can only do so much to stop defaults. They can't literally stop every company going bankrupt. So I think dividend cuts are going to be part of the story, particularly for energy companies, which is going to affect the FTSE 100, which is very heavy on energy. So Royal Dutch Shell, for example, is the biggest weight in the FTSE 100. And generally in the FTSE 250 as well, I think there are quite a few energy companies. So dividend cuts and defaults increasing. Those are the things I'd be very careful of this year. Oh, yes. Let me just say that you have to like, well, you don't have to obviously, but if you want to, you could always like this stream and then you can share it as well. And then, other people will perhaps know that we're having this conversation. And I should also say that today is the last day when our course on investing through the crisis gets a 25% discount on Patreon. So if you support us on Patreon, then you can apply for the coupon. The coupon is in one of the posts. You'll see the post for the coupon. And then you get a 25% discount on investing through the crisis, which you may find useful. So SAC Media says, come on people, like, share and smash that like button. Yes, thank you. That would be great. So, yes, if you would do that, it would be great. Yes. I'm a PensionCraft member and enjoy your work. DH, thank you very much. Our market's massively overvalued currently with COVID, depression risk, recession certainty, and valuations approximately 15% off all-time highs. In fact, it's probably worse than that. If you look at the forward PE, it's pretty much where it was before the sell-off. So I think it's around 19 times forward earnings for the S&P at the moment. So valuations are actually at all-time highs, or at least for 20 years, the highest they've been, which is going on at exactly the same time that you see 16% unemployment in the US, which is depression level unemployment. And in the space of 2 months, we've lost all of the gains in jobs that we've had in the US over the last decade, since 2010. So that's the scale of the economic shock. So I think people are a little bit too optimistic about the consequences of those economic effects on corporate earnings. I think once we start to get the second quarter earnings, which is about 3 months from now, I suspect that markets won't be so optimistic about the outlook. Equity markets simply overreact to bad news. So I think it'll be difficult to absorb that kind of bad data and remain optimistic. So I think it'll probably be a case of another sell-off, or at least a period of high volatility until we do start to see substantive rallies coming out of this. So I think it's going to be a long haul, in other words, before we start to see more stability in markets. We will see a period of high volatility for some time to come. Although VIX has fallen recently.
Super chat.
Oh, so we have a super chat, and I wonder if I can see it.
Read it out loud.
Oh, here we go. So JJ Jordan says, I'm new to investing. I have 40k index funds. And the question is index funds. Should I buy index funds? Well, personally, that's all I buy. So I never go for actively managed funds. I always go for index funds, and I try to buy based on valuation. So I look at valuation, I look at top-down information, and at the moment I'm very cautious. So personally, I've got 80% of my portfolio is in government bonds, 40% in US government bonds, sterling hedged, and 40% in UK long duration government bonds, and then 20% in Vanguard's minimum volatility fund, because if there is a period of volatility, that tends to at least dampen the volatility. So that's my portfolio. I'm not sure if that answers your question, JJ, but I think your question was about whether we should use index funds. Now, I'm about to publish a video about which talks about active versus passive. Now, in that debate, what it looks like is that stock pickers during these periods of market sell-off don't outperform. They don't outperform during normal good times, and when markets sell off, in theory, they should be better opportunities, because even the good stocks sell off as well. So that should be a good entry point if you can find those good stocks. And yet, when we look at performance of active managers versus the index, we don't see outperformance during market sell-offs. Active managers will tell you that they do, but the actual evidence is that that's not the case. And the evidence I've been looking at was the S&P index versus active report. But also there was a published paper by SCM Direct, which I'll be talking about in that video if you want to watch it. That'll be coming out probably on Saturday. So it's just talking about strategy through this crisis. Bob Taylor says, proud Patreon supporter. Thank you very much, Bob. That's great. Yes, and I should say again, please like the video. Please like this, because then people will think it's worth watching. Other people will think it's worth watching. Okay. So Connor says, I highly recommend the course that Ramin is talking about. I learnt a lot for £15. Now, normally that would be £20, but I assume Connor is a Patreon supporter, so he got the 25% discount, which you can get by signing up on Patreon and then going to the coupon. So you can still do that today. But the coupon is going to expire. Is it tomorrow?
Yeah, by tomorrow.
Yep, it's going to expire by tomorrow. So today's the last day that you can get the coupon. Anton Belev is saying, do you expect a second dip in the stock markets globally? Yes, I do, because I think the economic data is simply too bad to ignore. Plus, we're going to get earnings data looking awful, and we'll get an earnings recession. And when you get a large earnings recession, you almost always get a very big sell-off in equity. And the bigger the earnings recession, in other words, the peak to full drop in earnings for an index, usually the bigger the sell-off. So at the moment, we're pretty much recovered from the sell-off for certain sectors like healthcare and tech. But I think it's going to be there'll be another round of sell-offs, at least one, before we finally start to see the back of this terrible market period. Somebody says, how do we access the course? Well, it's on pensioncraft.com. You'll see the list of courses there.
In the description.
Yeah, it's in the description of the course, and it's in the description of this video, actually. So if you want to find out how to access the course, you'll find it in the description of the video.
I've just posted.
And Laura's just posted it, apparently. Thank you, Laura. Sandy Lowe says, great course. Looking forward to hearing about SCM Direct. Are they doing better than Life Strategy? Well, of course, SCM Direct are themselves active managers. They're kind of interesting because they're macro managers and they do try to keep their fees low. Because I think one of the things which is... Okay, active management is fine. I have no issues with it. It's just that the fees tend to be high. So as long as active management had a fairly low fee, fine. And if the fee was performance dependent, so they only charge you if they outperform, great. I think that's a much better system. But I think charging you 1%, whether they win or lose, and given that they lose about 90% of the time over 15 years, then, not such a great value proposition. So yeah, SCM Direct, I don't know, to be honest, how well they're performing. It'd be interesting to hear how they're doing. But I thought it was very nice of them to share that data, and it's a great article. This is brilliant. Thank you so much. Kenneth Adams says, would you currently suggest UK gilts if you're based in the UK, or go for global bonds? Thank you. Well, it really depends on how you feel about the UK yield curve. So now, what are the drivers of the UK yield curve? Well, issuance for one. So the question is, will the market absorb all the issuance of new debt, which is going to have to be created to pay for the bailouts, for the healthcare costs? None of this comes for free. And the way you kind of fill the cracks on your government budget is you'll get a certain amount of tax through the door, and you have a certain amount of expenditure which goes out of the door, and the difference you have to plug with debt. So if we have to issue a huge amount of debt, the fear is that people won't want to buy it. There'll just be too much issuance for the market to absorb. And if that's the case, then yields can increase. And when the yield on a bond goes up, the price goes down. So the worry is that the yield curve will start to increase, will start to rise, and that'll push down the price of bonds in the UK. So if you are worried about that the market won't be able to absorb all the issuance that's coming out of the UK, then yes, you could always diversify into other regions like the US. But bear in mind, when you buy foreign government bonds, that the volatility would be swamped by the foreign exchange conversion. So sometimes it's good to get a foreign government bond, which is very safe, but which is hedged back into your own currency. Now, normally the hedge doesn't cost much, just a few basis points, but it means you won't have to lose sleep at night over the FX fluctuations. So if you think your currency, the sterling in my case, is going to rally versus the dollar, that could reduce the value of my US treasuries. So that's why I went for a hedged one, because sterling had sold off a lot, so I was worried that sterling was going to rally versus the dollar. So Sac Media 1 says, smash the like button, people. Let's get 250 likes. Absolutely. Yeah, please do that. That would be great. Great course. This is brilliant. First time viewer. What's your advice to physical silver coin stackers who are waiting for inflation to boost the value versus fiat currency? Carry on stacking or diversify to government bonds? Well, generally, silver isn't such a good hedge as gold when it comes to fear, because silver is an industrial commodity. It's actually used for industrial processes, so it does have as one of its drivers economic growth. So in a recession, such as we're entering now, a synchronized global recession, the demand for those commodities tends to diminish. So if you do go for commodities, you'd go for ones which were, not linked to growth, like oil, like platinum, for example. It's a precious metal, but it's used for catalytic converters in cars. So as economic growth slows, you get less demand for those industrial commodities. So I'd be worried about silver, less worried about gold. I mean, if we do get another big sell-off in equity, then that would be good for gold. But I mean, personally, I just prefer bonds because they provide an income, and if equity markets do fall, then they do provide a good, reliable hedge against falls in equity markets, particularly the long duration bonds. So that's certainly what we saw in the previous sell-off in March. The long duration bonds were the ones which gained the most. So things like the iShares TLT ETF, which is 20 years plus in the US, and in the UK, long duration government bonds, long duration gilts. Those are both good hedges during the equity sell-off. What do you think about copper, zinc, aluminium as an asset going forward? They're at an all-time low now. Can we see an upturn soon in an inflationary environment? I mean, as I say, those are all industrial metals, and 60% of the world's copper usage, so 60% of the production of copper globally is absorbed by China, is bought by China. So if Chinese growth remains weak, which it is currently, then that would be bad for the price of copper. So the most important thing to monitor, I guess, if you think that copper could be rising, would be that demand from China. So it's very important to keep your eye on that. And also expectations of Chinese growth. So maybe you could look at the Chinese PMI index, which would give you a lead on Chinese growth, perhaps. That would be something to monitor. But industrial metals would tend to do well if we're exiting this crisis. At the moment, I'd still say we're probably at the beginning of the crisis, right? And whatever the crisis triggers after this crisis. Things like emerging market crises, which usually happen during shocks, macroeconomic shocks like this, often trigger an emerging market crisis or a credit crisis or pop credit bubbles, which we've talked about for a while, like the leveraged loan market in the US, like corporate bonds in China, corporate bonds in emerging markets. Countries like Turkey, for example, have issued a lot of corporate bonds. The question is, during this recession, whether they'll be able to service those, or whether we're going to see more crises as a consequence of this global synchronized slowdown. Tom Kidd says, did you mention a Vanguard US government bond but hedged against UK inflation? No. What it's hedged against is sterling versus the US dollar. It's the currency risk which I'm hedging, not inflation. Because I don't want to take that currency risk in case sterling rallies versus the dollar. And it costs very little for the hedge. So that's why I went for it. If you're in your 20s, if only, and only owned one single index fund, which would you pick? Probably a global one, because a global MSCI World may be one of the factor funds. So something like MSCI Growth or MSCI Quality. Maybe one of the factors. Who knows? Maybe even MSCI Value, because value's been completely slaughtered in this sell-off. And at some point it's going to come back. But I'm not sure I'd be brave enough to go for value. So probably quality, or maybe even better, small cap value, make it really juicy. Because, hey, I'd be 20, so I could afford to make mistakes. So yes, I should say again, please like the video, and then other people will know it's going on. And I'll say again, this is the last day when you can get a 25% discount on our investments through the crisis video. If you sign up on Patreon now, you'll be able to get the coupon and get a 25% discount on the course, which people on the chat have said they found very useful, navigating through the crisis. It's about practical it's a kind of practical guide as to what works and what doesn't work during a crisis, and how to value equity so you know when it's cheap, how to come up with your own valuation for equity so you know when it's cheap according to your own beliefs.
And what else do you get as a Patreon member?
Oh, and what else do you get as a Patreon member? I'm glad you asked. So you also get to join us on our Sunday evening call, and you get access to all of our previous Sunday evening calls and all the notes that go with it. So what we usually do is we have a series of questions like this. I prepare about 5 of them. I make detailed notes in a Google document, and then those notes are available during the call, and the video is me talking like this, answering the questions in detail, and the video is available afterwards, as are the notes. And you've got the whole catalogue of those going back over a year. So there's quite a bit of content there which people find useful. And you can join us on Slack. So let me just show you what that looks like. If I share my screen. Here we go. So this is Slack. So you could join us on Slack, and you can see people here talking about the price of oil. They're talking about life strategy, funds, talking about bail-in legislation, whether that's going to be problematic, about what happens to treasuries if there's a taper tantrum. So this is where we discuss stuff with each other, and often it's the community now which is helping each other, because the collective experience is now pretty vast. I haven't tried every single platform. I haven't tried many different investment styles, whereas the people who are now members have, and there are 400 of them. So I think you'll find the community also very helpful on Patreon. So back to the questions. Okay. Streaming. Yes, here we go. Go back. Oh dear, not doing well here. Very bad control of my windows. Yeah, here we go. Here are the questions. Right. Right. To me, the FTSE 250 looks like a fantastic index to buy and hold, and pound cost average. This is James. In fact, the returns on the 250 are similar to that of the S&P 500. Given that it's a UK index, it's a great fund to buy as there's no currency movements to worry about. Yeah, I mean, that's true. Sterling is so currency generally people worry less about for equity indices, because if the equity index has a volatility of 20%, developed market currency volatility is around 10-12%. So the volatility of the equity itself is usually much more than the foreign exchange. Whereas for bond funds, where the volatility is low, significantly less than the currency, there you can be swamped by the risk of foreign exchange. So that's why for equity funds, normally you don't hedge. So I wouldn't worry too much about the equity currency hedge aspect. What I would worry about is whether you think the UK will outperform. So it's true that the UK was undervalued going into this crisis, but if you actually look at what happened, the FTSE 250 sold off more than the S&P 500. So I'd be very cautious about expecting outperformance from the UK relative to the rest of the world. I mean, personally, I'd go for much more diversification globally and not concentrate my risk in my domestic market. I think there are lots of reasons to expect that growth will be weak in the UK. We're a very open economy. We're now a relatively small economy compared to the economy on our doorstep, which is Europe. And we may be about to enter difficult trade negotiations where we could be slapped with tariffs, which would be damaging to the economy. So 50% of our trade, remember, is with Europe. And it's very unlikely to change overnight. So I'd be very cautious about being overly optimistic on the UK's prospects relative to the rest of the world. You're probably much safer diversifying across markets globally. So I'd be careful about being too optimistic about the FTSE 250. Also, the UK has a weird composition, which is to be underweight tech and overweight energy. Now, in this environment, the sectors which have done well are exactly the ones where the UK is underweight. So it's tech, and for energy, obviously that's been very badly damaged. So, very, very kind of open economy is going to be hurt in a globally synchronized slowdown. So I'd be very cautious about having that exposure. Plus, avoid domestic bias, because generally it's not a good idea. So diversify by all means, have an overweight for the UK if that's what you think will outperform, but don't go all in on the FTSE 250. Plus the dividends are likely to get cut very severely as we go into the crisis. And that's one of the attractions of the FTSE 250 is its high dividend yield. So just be careful about that. iShares MSCI World Quality, the ticker is IWFQ. That's Ely River Blues. Thank you for that. For the S&P 500, the historical average of the PE, which is 16, seems like a floor for many people nowadays. Yeah, so that's the CAPE, I guess, is what you're talking about there. So the cyclically adjusted price to earnings ratio, the median over 140 years is about 16. So we're well above that now. We're at around 30, I believe. So we're well above that average fair value for CAPE. Valuations are still very high. Ramin, would you recommend to diversify based on factors? And if yes, interesting question. How would you do this? Many thanks. Well, it's difficult to do that actually, because factors in the form that you buy them for retail investors are mixed up with beta to global equity. Now, if you were a hedge fund, what you'd do is, let's say you wanted to build a value fund, you'd buy equities which are cheap. So you'd go overweight, you'd buy equities which are cheap, and you'd short companies which are expensive. And that way you could be market neutral. So if the S&P 500 moves up and down, you'd be completely insensitive. Your return is purely generated by whether value outperforms growth. Yeah. So you can buy pure factors if you're a hedge fund. If you're a retail investor like us, then the problem is that you buy a chunk of global equity exposure, which is a little bit overweight value rather than pure value. Okay, so that's the problem. So you can't buy pure factors. That's what I'd say. So I'd be very careful about mixing those factors because you just buy more global exposure. Those factor funds tend to be highly correlated with each other and with global equity. So Rory MC says, thank you for your help with all this complexity. Thank you, Rory. Thank you for the comment. That's very kind of you. And thank you for your super chat. Was there any other question from Rory? No, I don't think so. He's just saying thank you for your help, which I appreciate. That's great. Al Lorio says, I'm a proud patron of Pensioncraft. Thank you, Al. We appreciate it. I'm 31 years old, but I get to learn investment wisdom from other Patreon members, and especially the great and generous Ramin. That's very kind of you. Thank you. Asim says, how long do you think it will take for the market to recover? I mean, I don't know, and the Fed doesn't know. It really is a matter of knowing what to look at. So which indicators should you be looking at to see that there's a sign of recovery? There are certain high frequency data points you can look at. So initial claims in the United States has been kind of warning us week by week, because it's published weekly, that US employment is falling off a cliff. More or lower frequency data like PMIs, another thing to look at. So purchasing managers indices, which are published by Market, which I talk about in my free newsletter, which you can sign up for, which generally give you a lead on growth. So maybe tell you something about corporate earnings as well. But they certainly are quite useful for finding the turnaround in the economy. So, for example, in 2008, 2009, March 2009 was when markets reached their bottom for equity. And that's also when the PMI indices started to turn around. So for finding the bottom point, they're quite useful. So that might be something to look at. Al Lorio says there's a great community of like-minded individuals as well. I think that's one of the great things, actually. I'm very impressed with the community we've got at Pensioncraft. Generally, the people are very supportive. I mean, we when people join, we say, you know, obviously you can't be rude to each other. Please be courteous. And for the most part, I'd say about 99% of the time we are, and it's a very supportive environment. So I'd say it's a great community to be part of, and I'm personally very proud of it. Kenneth Adams says, can you just buy an ETF of long-term government bonds and effectively dip in and out, or do you have to hold to maturity? I realise this may be a silly question. Not silly at all, actually. Generally, what people do is they buy the ETF, which buys government bonds, and then once the bonds mature in the fund will buy more government bonds. So they take care of all the kind of treadmill of maturing bonds, buying new ones, and so on. So they maintain the exposure to government debt. So you don't have to worry about that. And generally, it's a bad idea to trade in and out of funds too often. I try not to touch my portfolio more than a couple of times a year. I mean, obviously, through this crisis, I've been doing a bit more buying and selling than usual. But my purchases are very boring, which makes doing videos about them very difficult. Just saying, and nothing's changed, and I haven't changed my portfolio, is quite difficult to do and quite boring to watch, I expect. But hey, I think it's good to say these things. What's the minimum amount in a portfolio in order to join your group? Okay, this is Oliver. To join, you just pay $10 a month on Patreon. So you go to patreon.com/pensioncraft and you just join us for $10 a month. And then you get a welcome email, you get a Slack invitation, and you're off. That's how it works. And you get access to all the previous videos and Slack and our Sunday evening call. Ramin, do you feel fear of missing out in the recent rally? If not, why? Well, I don't actually, because I sold right at the top. So right when, just before market sold off in February, I noticed the valuations were very high. So I sold my equity, half of it. So all I'm left with now is 20% equity. Now, why did I keep the 20%? Because I could be wrong. So we could get an equity rally, but I don't think it's going to be great. So do I regret not buying more equity at the bottom? No, because I think I don't want to buy without some kind of justification. I'd rather miss out on a rally which I don't understand. So I'm quite happy to miss out on returns while valuations are this high. What would make me happy is for valuations to fall, and then I can buy with a clear conscience that I'm buying at a reasonable price. I just don't feel that at the moment. I'm feeling that equities are overvalued, far too overvalued, given what's going on. So no, I don't feel FOMO, actually. What government bonds do you think have the best risk-return ratio right now? Maybe US 10-year or China. China's an interesting one because the government bond market in China is actually done quite well, and it's got huge government support, kind of like the US government bond market. Plus the yield is higher, but obviously it's high risk. But US 10-year, yeah. I mean, it's still got a reasonable yield. It's not good. It's not great, but relative to the rest of the developed world, the US is still giving you a fairly good yield, given that it's practically risk-free. So I'd say the US is probably the one I'd consider. I mean, it's the one I own, right? So the US and the UK. But if I was a bit braver, I might consider China, but I'm not, so I won't. I liquidated my portfolio 2 weeks ago. Dayglow Vista says, if you were my father, am I? Would you be mad? Yeah, probably. No, seriously. I mean, I think a lot of people have said this to me, that they've liquidated their portfolio, and it's almost like an admission, right? It's like confessing. Generally, it's a bad idea because, you get locked out of markets and then they start to rally almost invariably and you're locked out. So what are you going to do? So the point is, only sell if you have a very clear idea about when you'll get back in and you realize you may have to buy in at a higher price. So yeah, I'd be very disappointed. I wouldn't be angry though, I'd be disappointed. So JJ Jordan is asking a question. As the markets are all mostly down and slowly recovering, I'm looking to invest for around 30 years in accumulation funds such as the FTSE and the S&P. Surely now is a perfect time to invest. Well, as I say, I think, do look at those forward PE measures. So if you want to see how to do that, let me just quickly show you. So if you go to Insight at FactSet, and every Friday, so tomorrow this is going to come out again. Can you see my screen?
Not yet.
Okay. So you go to this this site, and then every Friday they publish the latest update to the earnings season, and they give you the forward PE for that week. So let's see if I can find it for last week. When was that? That was 24th. So it's actually gone off the bottom. Okay. But anyway, so look on here, and you'll find the price to earnings, forward price to earnings in that document. So, and then what you can do is you can look to see what the valuations are. The point of doing that is that you can see whether markets are currently pricing in any kind of earnings downgrade or not. So that's why I think it's worth having an idea of where markets are relative to their fundamental value. So generally what you find is that when the price to earnings ratio is low, the decade returns following that are higher. So if you buy now, we're probably going to see volatility, so markets will fall before they rise again. So as long as you're sure that you won't sell when that happens, then yes, buying equity in this environment is probably a good idea, as long as you realize you're going to hold it for a long period of time and it's going to cause you grief. It's kind of like having children, right? It's not easy, but it's rewarding if you're willing to go through it for the long term. So yes, buy equity, but just make sure that you don't sell when it falls, is what I'd say. If you have that discipline, then yeah, you can buy in this environment when valuations are still quite high and the economy globally is falling off a cliff. But just be aware that there may be better entry points further down the road. So maybe dollar cost average, because you may not find the bottom. But if you drip feed money into the market month by month, then if markets do fall, you'll pick up those better prices, those better entry points as we go through that volatility. So perfect time, I'd say probably not, because of the valuations. How are we doing for time? Well, we're past an hour now, but so I'll kind of wind things up. 7 brand deal confirmed. Product placement, yeah. Thank you for that. Want to get your thoughts in the triple B corporate bond scenario right now. This is João Pedro. Okay, so it's kind of flooded at the moment and the risk of falling below investment grade is high, making prices drop as well. Yeah, I mean, this is why I sold my credit exposure, even though it was investment grade UK bonds. A huge amount of triple B debt has been issued. So about half of the global corporate bond market, half of the investment grade corporate bond market is triple B. So that's the lowest rung of debt, of investment grade debt. And all it would take is one downgrade and that becomes junk. And then all the investment grade funds can't own that paper. And then you get a spiral of price falls as fund managers have to sell. And then you can get this cascade effect where funding costs increase as they have to issue new debt, these lower grade companies. And then you get more downgrades, and then you get this kind of credit spiral, which is hugely problematic because once it starts, it's very difficult to stop. So there's a question about how much junk bonds the Fed can buy. They're doing it through an ETF with their secondary market credit facility at the moment, but they just can't buy a proportion, significant proportion of the junk bond market. They just couldn't. Because there are questions about solvency. I mean, that's the whole point of junk bonds. So if they were going to stand to make a loss on those investments, they wouldn't be allowed to make them. So I think there's a real risk that we could get this credit spiral triggered by the downgrades from triple B to junk. That's certainly what happened in 2008 and 2009. We had a very significant proportion of the triple B stuff, triple B paper, being downgraded to junk. And if that were to happen now, it would be a real problem. So I'm very worried about that. I think that's one very likely outcome of the economic shock. Good question. Which bonds are a good investment in this environment with interest rates close to zero and possibly to become negative in the near future? Well, of course, if they're zero now and they become negative in future, you'll make a gain. right? That's the logic behind, people buying government bonds now. They're very low yields. The point is that if equity markets do sell off more, then the bond prices will go up and the yields will go down. There's no lower bound for yields on government bonds. It can go to -5, -10% in theory. It's just another way of quoting the price on a bond. So, the point is that you'd lose less on the bonds than you would for equity, which is why people still buy them, even if yields are very low. But I don't buy into these theories made famous by people like Ray Dalio, who's a big hedge fund manager, saying that the US has a risk of defaulting. I just don't see that happening. I think it's very, very unlikely. Do you think we could return to a gold standard? Unlikely. There are many reasons why you wouldn't want to do that. So a lot of the stuff that the Fed is doing now in order to stop financial instability is due to the monetary flexibility it has, its ability to print money, which it couldn't do if it had a gold standard. So, if you disagree with the bailouts, that's why some people are saying we should go back to a gold standard. I don't agree with them, and the vast majority of economists don't agree with a gold standard. So, I think it's very unlikely. It wouldn't be the solution to the problems we've got now. Put it that way. I'm pound cost averaging, haven't stopped, just been adding more when prices dip. That is awesome. Well done. Vanguard Value is doing well. Well, it's sold off a lot. It's done well very recently over the last few days, which I think is what you mean. Akshay says some sectors are valued very attractively, like consumer discretionary, financials, energy. If you actually look at the S&P 500, they're all overvalued except for consumer discretionary, which is roughly at fair value. So, yeah, I'd be cautious about saying they're reasonably valued. Are you talking about the US? If so, have a look at that FactSet report. It has one of the graphs is the forward PE broken down by S&P 500 sector, and currently they're all above long-term averages. So the only sector which is not, I think, is consumer discretionary, I think. But do have a look at that. It's freely available. Okay. Do you think we could be entering a depression? This is Ethan Koski. Yeah, I think it's very likely that we're going to see atrocious growth numbers, like numbers that we will never see again in our lifetimes, hopefully. So US growth, which is, even double digits negative for one quarter, which would have been unthinkable just, 2 months ago. So a synchronized stop in global growth has never happened before, but the consequences of it will be numbers which are just off the scale, like we saw for initial claims, right? We've never seen numbers like this. So we are talking about perhaps a speeded up version of the Great Depression, but ultimately there will be a vaccine and there will be a way out of this, which there wasn't for the Great Depression. So I think, things will get better, but I think it's going to get pretty much worse until that happens. Until we do have some kind of vaccine. So what about crypto? I guess you're saying slow long run. Personally, I'm not a fan of cryptocurrency. So I think as a store of value, it's not great. But hey, the volatility on equity has been so crazy recently that suddenly 80% vol for Bitcoin doesn't look quite as bad. But what is clear is that during the sell-off, cryptocurrencies sold off, right? They weren't a safe haven. If they were, they would have rallied like treasuries during the March sell-off. So I think saying that they are a safe haven is deluding yourself. They are a risky asset. So in a market sell-off, I wouldn't use them as a hedge. would it be sensible to buy a little bit as part of your portfolio for a long-term play? Because people like to play with stuff. You know, you could buy Tesla shares, high risk, potentially high reward. Yeah, but would I put a significant proportion of my savings into it? Or would I, you know, talk to other people and counsel them that it's a good idea? No, because I think it is experimental. It has a very high volatility, and I'd be very concerned that it wouldn't be a good store of value. Why can the government stop printing money to stop inflation? It depends on the cause of the inflation. So, for example, if the inflation is caused by demand increasing, so if you have very rapid growth, very unlikely in this scenario, I'll admit, but if there's very rapid growth, people's salaries are increasing, for example, there's greater demand for goods and services, that pushes up the price of goods and services, then what the government generally does then, or at least the central bank, is to raise interest rates, because that effectively takes money out of people's pockets and takes away the punch bowl, as people say. And that slows down the economy, and usually that's enough to dampen inflation. But the difficulty with inflation is expectations. Inflation, the key thing is to anchor people's inflation expectations. If people think inflation is going to increase, that anchors their expectations higher, and that can be a self-fulfilling prophecy. And that's why you need a credible central bank, because they can anchor expectations. A central bank which isn't credible wouldn't be able to do that, and that's when you really run into problems with inflation. Anchoring is all important, and I think that Jay Powell has done an amazing job. He went in with all guns blazing straight from the beginning, threw caution to the wind. He's got bailout after bailout after bailout to try and keep credit flowing to where it's needed, stopping liquidity drying up. So that's been an incredible job by the Fed. And, you know, I think we should thank them for that. Equity markets very clearly reversed on March the 23rd when the Fed announced it was going to have unlimited purchases. So I think if we are going to worry about inflation, it'll be much further down the road. At the moment, people are more worried about deflation due to a lack of demand. And the Fed is trying to avoid that too. Russia's at around 6 Shiller PE. Why are investors staying away? Because in an emerging market, because in a crisis, emerging markets tend to sell off. So we saw emerging market flows into emerging market funds effectively stop overnight when equity markets sold off. Also, Russia has a huge exposure to oil, and obviously the current value of oil, the price of oil is extremely low. So that's not great. The combination of a global slowdown in growth, a kind of scary equity market, combined with low oil prices, mean that Russia is probably what most people are avoiding, one of the countries that they're avoiding at the moment. So I think that's probably why the Shiller PE is so low. So I think I'm just off to buy some 7-Up, Andy says. That's great. That's great. Obviously my job is done. Okay. Right, so I think we're pretty much done. Thank you everyone for dialing in. It's been great. Some wonderful questions as usual. I would say again, if you want to buy the course, today's the last day when you can join us on Patreon. Go to patreon.com/pensioncraft. You can support us for $10 and you get 25% off the course with a coupon and investment navigation through a crisis, which I think you'll find useful for the months to come. Thank you for dialing in. It's been great. Do join us on Patreon. It's great as a community. I think you'll find the other people very helpful. And thank you all for your time. It's been great. Thank you for spending your evening with me. And my 7-Up. Cheers.